Curious how to get equity out of your home? We're going to talk about that next. Hey there, it's Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates. And we're going to start off with those interest rates. Just as I told you last week, and I'll put the video there above. I knew we were going to see it because we already saw those rates start to jump after the consumer price index came out and showing a lot of inflation. So we saw interest rates move up. According to Freddie Mac, 3.1 on the average 30-year fixed, according to Freddie Mac. So while you're down there, click the link and be able to find that chart on the weekly survey. You can see that 3.1. You can see that we actually came from 2.98 last week. So a pretty big jump. So check out down below. You can see that link. And while you're down there, hit that like button, hit that subscribe. I'd be forever grateful for the subscribe. And then also click that bell icon to be notified because I'm putting out weekly videos on the channel. Now, the topic today, how to get equity out of the home. I love that commercial. They're banging away at the wall trying to find money. Absolutely great. So there's a couple different topics we're going to talk about today inside of that equity in the home conversation. And the reason I'm bringing it up today is that equity positions in homes are, at an all-time high right now, or at least in terms of the last decade, 15 years. There's more and more equity built into homes than there ever has been before. So, what do you do? What's in there? Why is it a good idea to be able to tap into some of it? So two different kind of things we're going to talk about today. First of which is a cash out refinance. Let's say you buy a property for 500,000 and all of a sudden it's worth 600,000 a few years later, or 3, 4, 5 years later. And especially in these last few years, we've seen prices appreciate. Let's imagine that you took out a $400,000 loan at that point. Now you've paid that down a little to say 380. Well, when you look at now a home that is valued at 600,000, let's say 80% loan to value, right, is now a much higher amount. So now that amount is 480. If you owe 380, 80% is 480, you could get $100,000 of cash out of that property. Obviously, you have to be credit qualified and apply, but that is literally what a cash out refinance is going in, diving in and taking some of that cash back out. People do that for a host of reasons. Potentially kids going into college. Maybe they want to buy a second home or something like that, or an investment property. They want to get a little bit of money out of their primary home. And again, for tax deductibility reasons, there's a lot of good stuff there. Now, I'm not a CPA, but you should consult one if you have questions on that. But a great way to get money out that way. You could also look at, you want to do home improvement. A lot of clients, instead of going through and trying to pay for it themselves, will take some money back out of the home to then do that self-improvement, hopefully, increasing that overall value of the home. Now, that's a simple cash out refinance. So I'll leave that there. That's pretty simple concept, taking a higher loan amount than what you have, taking some of that cash out, and really doing as you see fit with. The second of which is what we would call a HELOC, or a home equity line of credit. HELOC, home equity line of credit. So typically this product comes in second position. So you've got your first mortgage here, and let's say in that previous example, you owe 380, and then a HELOC would come in right below. It is a line of credit. So it is a mortgage. It is a lien against the property. So you do record it. It is a mortgage transaction. You need a little bit less documentation as a whole for those, but you still need to get credit qualified, still need to apply to see if it's there. So what the product is, typically it is just like your credit card. If you look at your credit card statement, it's like prime plus 15% is your credit card rate. So let's imagine, to use easy math, you're at 3% on prime and it says plus 15. So your credit card is 18%. Well, most lines of credit are prime plus 1, prime plus 2, something like that. So you could see, today being, November 2021, you could see a lot of home equity line of credit rates, in the 4s, 5s, just depending upon what that might look like. Now, again, you've got to be able to apply to actually see what the APR and some of these other things are. But to give you a range, pretty low interest rate overall, not as low as actually doing a, kind of standard mortgage, but definitely a good opportunity to go in and get money out of the home. Now, the home equity line of credit, typically you pay back just the interest of what you drew out. So if you have a $100,000 line, you decided to only take $10,000 on the line, you're only paying that interest on that 10K back, right? You're not actually paying down the principal. So they can be dangerous, but they're a great emergency fund, great backstop, great way to finance some other things. For the right scenario, you really need to consult a knowledgeable loan officer to be able to run through your entire scenario and say, hey, does this make sense? Is maybe a home equity line of credit, maybe a cash out refinance, maybe we should just finance this other thing that we're trying to do in a different way. So, home equity line of credit, typically just interest only payments. You can draw on it typically, again, for about 10 years. And then they'll cap you and they'll say, okay, you got to pay back whatever you owe over the next 20. So it really is a low payment and a great opportunity to pull some money out of your current home when the equity positions are high. So that's a home equity line of credit. And then also that cash out refinance. Those are your two ways to be able to tap in to that equity you've potentially built in your current home. My name is Ryan Skaggs for the Mortgage Minute. Thank you so much for tuning in, and we'll see each other again very, very soon.